Has the Fed given up on fighting inflation? It sure seems to me that it looks that way. Stick with me and hear me out on how I think the Fed has officially thrown in the towel on inflation altogether. It's got some alarming quotes here and a couple of quick hits before we get started in this video. The Federal Reserve still expects 3 rate cuts in 2024 in spite of continued inflation. Strategists project gold moving deeper into record territory on falling real yields. Now, I've got a ton of quotes here in this video, so I'm going to read them off, so please stick with me until the end, as some really powerful people in the world are saying some stuff you're going to want to hear. And if you hear this, you could help maneuver the economy for yourself accordingly. What I mean is moving around money and being prepared for what could happen. Now, as we sit around the all-time highs with gold trading at $2,200 an ounce, gold continues to dominate over the last month. I looked into a variety of reports, and the analysts are all over the board saying that the reasons for the global demand of gold is because of these 3 main factors. I whittled it down to these 3. Number 1, we have a lot of geopolitical turmoil and tension in this world. No need to extrapolate on that one. 2, America's deteriorating fiscal stability. Number 3, the fact that a bunch of central banks are diversifying into gold and moving the reserves far, far away from the US dollar. And who could fault them? And not to sound like an infomercial guy, but that's not all. The analysts also say that the prospect that lower interest rates finally may be here sooner rather than later, and that is very bullish for gold prices. But wait a minute. You're probably saying lower rates, lower interest rates. You might be asking, why would central banks lower interest rates? Isn't inflation still a problem? Hell yeah, it is. Just go out and buy groceries. It's right in front of your face. I see it every day. The higher inflation that first began way back in April of 2021, when the Consumer Price Index initially poked its head above the Federal Reserve's 2% target level, is still with us today, over 3 years later. Now, after reaching a peak annual rate 9.1% in June of 2022, inflation has been on the way back down ever since. But the closer to Earth it travels, the longer that journey seems to take. Just go look at beef prices right now. That's one that sticks out to me like Shaquille O'Neal sitting in a room full of jockeys at the Kentucky Derby. There. Now, economists refer to inflation that seems to get more persistent the more it declines and is sticky. And I'll get into that more. Let's elaborate on that one. And it seems that despite the stickiness of inflation right now, the Federal Reserve could be on the verge of loosening interest rates. That's been rumored all over the board, and I gathered, again, a lot of reports to create this content today. Altering course and deciding to end the explicit fight against inflation before that foe has been clearly vanquished. It is a pretty big deal, actually. That's because doing so could imply that the Fed is abandoning its long-standing, carved-in-stone target of 2% and telegraphing a willingness to actually accept higher inflation as part of the currently evolving economic environment which we live in today. Now, previously, the Fed suggested that defeating inflation is the most urgent matter at hand. But there are suggestions out there that the central bank may have concluded that it's pressing its luck by keeping interest rates in such a relatively restrictive territory for such a long time. And that's the most prudent course of action, all things considered, is that to begin loosening even as inflation remains at target. Now let's talk about what all this means for precious metals, because look, while declining interest rates in general tend to be good news for precious metals, lowering interest rates even as higher inflation persists can be particularly very good news if you're holding metals like I am. So let's talk about all of that. Now, in spite of persistent inflation, the policymakers say to look for 3 rate cuts in 2024. I can't say that enough, so mark this down. If the central bank abandons what has been its single-minded focus on getting inflation back to 2%, it won't be for a lack of trying to get the job done. They've done a lot of different maneuvers and it's just not getting it right. Whatever criticisms can be lodged fairly at the central bank for waiting too long to attack price pressures initially, the Fed's resolve in fighting inflation, once it decided to actually fight inflation, cannot be questioned. For example, from March 22 to July 2023, the Fed raised interest rates by 525 basis points. That is the fastest pace rate increases in 40 years. It appeared policymakers were making progress when they did this against the backdrop of stringent rate hikes. Headline CPI fell from 9.1% in June of 2022 all the way down to 3% a year later. But the return to 2% level was practically, and it seemed, right? We all thought it would get in there, but it wasn't, and it isn't. Since all items CPI dropped to 3% in June 2023, that metric not only has fallen further, it's remained above 3% every single month since, averaging more than 3.3% from July of 23, just until a couple months ago in February of 2024. The news has been largely the same with respect to core inflation, which excludes all food and energy prices and is therefore considered to be a more accurate reflection to underlying economic inflation. Now, last December, the core CPI finally drifted below 4% for the first time in 31 months, coming in at just under there at 3.9%. But its rate of decline has been at snail's pace since, and as of last month, core had dropped only as far as 3.8%, which is still nearly twice of the Fed's target of 2%. So, hey, we're still up there. And so recent inflation numbers have continued running hot. Expectations were growing that the Federal Reserve might actually decide to formally back away from the earlier projections of the 3 rate cuts in 2024 that I just talked about. However, that's not what happened. Although Fed officials kept rates in the 5.25 to 5.50 range at their policy meeting earlier this month, the updated summary of economic projections, which reflects where Fed officials think key data such as GDP and inflation and interest rates are actually headed, again indicates 3/4 point rate cuts by the end of 2024. Given inflation's persistence, that updated set might be viewed as a momentous declaration on the part of the Fed because it implies the central bank could be willing to cut interest rates before inflation is actually back to its target again, which is at 2%. Now, comments made by Fed Chair Jerome Powell at the post-policy meeting press conference seem to underscore this notion. I'll break those down next, as well as look into why one of the world's most respected economists thinks that what the Fed did and what the chairman had to say could be the sign the central bank actually might be stepping away from adherence to a formal inflation target. Now, I'm going to quote Jerome Powell right here, who said this: "It's appropriate to dial back policy restraint this year." Okay? Whitney Watson, who's the co-head and co-chief investment officer of fixed income and liquidity solutions at Goldman Sachs Asset Management, also had a message for her clients shortly after the conclusion of the Fed's policy meeting last week. And what she did was she told her clients, and I quote, "Despite projections of stronger growth, lower unemployment, and slightly higher core PCE inflation, policymakers still anticipate 3 cuts this year." So a lot of people are saying this, a lot of people believe it, and are on board with the 3 rate cuts this year. Concerns had started to grow that central bankers might dial back those expectations as signs persisted of both continued inflation and a tight labor market. But the updated SEP seemed to subdue those fears, as did remarks made by Fed Chair Jay Powell at the conclusion of this policy meeting. And to quote Jay Powell, "We believe that our policy rate is likely at its peak for this type of cycle, and that if the cycle evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year." That's what Jay Powell said during his talk. Now, referring to the hotter than expected inflation data that came out in January and February, Powell seemed pretty confident, considering his history and tendency to downplay any signs of improvement in inflation. Now, Powell said that those inflation figures, and I quote, "haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road towards 2%, end quote. Underscoring where it certainly sounded to be a more relaxed posture on the effort to get inflation back to target, Powell also said that we are strongly committed to bringing inflation down to 2% over time. But we stress, this is very key, over time. It's not going to happen overnight. Now, when I hear this, I see the relative lack of urgency implied by that last statement. It seems like a far cry from the chairman's outlook just back in August of 2022, about a year and a half ago. He expressed during his keynote address at the Jackson Hole Economic Symposium. He said the historical record cautions strongly against prematurely loosening policy. And he also said we must keep at it until the job is done. So that's a big shift and change of heart, if you ask me. Notable, too, was the chairman's remarks about winding down quantitative tightening, a mechanism by which the Fed reduces excess liquidity from the financial system by allowing the bonds it purchased during quantitative easing to reach maturity without replacing them. Now, through that process, the Fed has reduced the size of its balance sheet by about $1.4 trillion since the COVID-related peak of April of 2022. But in another tip of the hat to the growing prospect of a pivot to easier money policy, Powell strongly hinted that the time for quantitative tightening could be drawing to a close. And I'm going to quote him one more time. "While we did not make any decisions today, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued," end quote. Now, some observers seem genuinely surprised at just how dovish the central bank's posture is right now at the moment. Among them is the renowned economist Mohamed El-Erian, who thinks that the dovishness may telegraph a sea of change in how the Fed is looking at inflation targets. Now, the economist El-Erian said that the Fed may have, and I quote him, "formally stepped away from strict inflation target." Okay, that's an outside opinion right there. It's a pretty strong one, actually. And during an appearance on last week's CNBC Squawk Box, which I have playing in my office all day long, he related his interpretation of the posture assumed by Fed policymakers this month, saying it effectively sends a signal that they're willing to tolerate higher inflation for longer. So that seems to be a major theme in today's update. Inflation's going to be lingering around for a long time, and they don't really care about it anymore. He also referred to the Fed's apparent tolerance of both higher inflation and a higher balance sheet as twin patients, saying that he thinks that the twin patience means that they may well look back on this week as well as the week in which the central bank stepped away from a very strict inflation target to a much broader concept of an inflation target. Now, in the economist's view, the Fed is shifting its view from this way for two real reasons, as far as I can see here. Now, referring to policymakers, he said that he thinks that they realized two things. One, the economy is indeed weakening. And that two, we're living in a world in which the supply side is the problem behind the actual inflation. The significance is that supply side catalysts of higher prices, such as supply chain issues, which my fiance deals with every single day in her work, inflexibility to the labor market, and increased costs associated with the green energy transition cannot be readily influenced by monetary policy as demand catalysts. The other reason the Fed seems to back away from its use of policy to continue battling inflation, in El Arian's view, is the perception that the economy could be slowing down. It is what it is, guys. Going to quote him again. The Fed realizes the economy is weakening, he said, pointing to signs of fragility in manufacturing and employment data. Those reports are out there. You can read them. This man speaks from facts. Ultimately, he said that the Fed will have a choice. It accepts slightly higher inflation, or it unnecessarily tips the economy into recession by keeping monetary policy in restrictive territory. So we're going to go one of two ways here, and I feel like we're at the latter. In his view, the central bank has chosen to accept higher inflation. This is perhaps why they're buying gold in record numbers. It's all out there. You can read about it. I've talked about it many times. Now, if you're like me and hold gold in your IRA or 401k, this is significant news for you as a precious metals investor. If you haven't diversified yet, you aren't too late. It's actually a good time to move some money out of the red-hot stock market. Even 5% of your retirement savings could really make a massive difference over the next few years if we get into a recession and the markets start tanking. There's a link below if you're interested in that. It'll match you up with a company based on your time horizon and goals. Feel free to take that quiz if you're interested in that. Now, wrapping up, let's talk about why many people are starting to make this exact move. JP Morgan said that rate cuts and falling real yields will be mono driver behind gold's rally. That's a direct quote. There are a number of meaningful implications associated with reducing interest rates even as higher inflation continues. One is the possibility that cutting rates this way could reignite the very price pressures the central bank has worked so hard to contain. But another more pleasant potential implication is the beneficial impact that such a move could have on precious metals, and that's why we're here. As noted at the outset of this piece, gold appears to be benefiting from several structural drivers right now, and that's according to the analysts out there at JP Morgan. But those same analysts also put at or near the top of the primary gold price catalyst the reduction of interest rates in an environment where inflation still remains an issue. It's still lingering, and they think that's going to drive gold. Now, that's because cutting rates during periods of elevated inflation reduces real or inflation-adjusted yields. Inflation always eats into whatever is earned in nominal terms from an interest-bearing vehicle. But when rates start coming down, the degree which inflation consumes profits becomes even greater. And if rates fall below the rate of inflation, that, my friends, means that real yields have turned negative. Furthermore, gold has a history of thriving in this kind of monetary environment. Lower real yields tend to make dollar weakness, which is typically a reliable gold driver, as well as a lower opportunity cost of holding non-interest paying bullion, which is also good for gold. One of the many investment banks that see gold potentially benefiting this year from lower rates and real yields is JP Morgan. They say that gold's inverse relationship to real yields has historically been weaker over Fed hiking cycles before strengthening again as yields fall over a transition into a cutting cycle. And this thought comes to us from one of their guys, Gregory Shearer, who's the head of base and precious metals strategy at JP Morgan. So he's in the field with precious metals. This is his take, referencing the expected impact to yields throughout the rest of the year. Based on projected rate cuts, Shearer added that we think over this period, the Fed cutting cycle and falling U.S. real yields will once again become the mono driver behind gold's breakout rally later in 2024. So we're not even there yet, and gold's at an all-time high. Pretty crazy to me. At the time, Shearer said he expected gold to reach $2,300 later this year. The price target of $2,300 per ounce is also what analysts at other global banking behemoths like Goldman Sachs have in mind before the year is out. They too see declining real rates as a key of realizing that price. The most recent Fed meeting reinforced the market's expectations that 3 cuts are likely this year. That's their take as well, so everyone's saying 3 rate cuts. Lending renewed support to gold tested surpassed March's earlier record high, and that's from the Goldman analyst again, and JP Morgan director says that gold is the firm's #1 commodities market pick, and in a more recent price projection from JP Morgan, one of their strategists, Natasha Kaneva, who's the managing director over there, said that her team sees gold rising as high as $2,500 per ounce this year, largely on metals, favorable climates that would be created by anticipated rate cuts. So again, these rate cuts that are happening are amazing for precious metals. That's why I'm in it, among other things, of course. Caneva also said at the time that JP Morgan's #1 pick is gold in the commodities markets this year. Again, it's all out there. Everything's pointing to it. It seems a little odd considering that the Federal Reserve actually might throw in the towel fighting price pressures, particularly in the light of the central bank's long-standing position that it would do whatever it takes to get inflation back to 2%. We don't really see that happening. Here we are. All things considered, it's perhaps the most prudent path in terms of the well-being of the economy. We're going to have to wait and see, and assuming that policymakers do begin these 3 rate cuts while inflation remains elevated, it's going to be crazy what it does to the markets. We know it's good for precious metals. As far as the potential impact of such a move on gold, analysts are out there saying that it's very confident that it's going to be a benefactor of this, and perhaps a substantial one too. And that too is a matter of wait and see. Investors who think gold's fundamental properties make it an appropriate consideration for their portfolios might feel even more positive about their investment now, hearing all this stuff. I know I am. Based on the metal, based on the projected path of monetary policy through at least the near term. Some who are near retirement investors specifically might see it fit to acquire gold or even silver like I did through my IRA. It's up to you. You can protect yourself. You can throw this information out the window, whatever it is. Just giving you the data from the economy as it comes out. Drivers are pointing to gold and silver going up. If you're near retirement, think about diversifying 5 to 20% of your portfolio, or you could lose everything you saved for the last 40 to 50 years if the market totally plummets, and then what's going to happen to your retirement? I know I feel protected doing this move. Again, a lot of the signs I pointed out to in today's video point to a stronger rise of gold this year. Those are the possibilities out there. That's what we're facing. That's today's news report. Thank you for watching. I'll catch you next time, and please leave comments in the section below. We'd love hearing from you.